Definition of capital market. A capital market is a place where supply and demand meet long-term funds that are manifest in the form of the sale and purchase of capital or marketable securities. In the capital market, which is also called the stock exchange, there are a variety of long-term financial instruments that are bought and sold, such as bonds, mutual funds, stocks, gold, insurance, land, buildings, and others. Here, the capital market acts as a relation between investors and companies or government institutions. In terms of the offering of securities, the capital market divides into two, namely the primary market and the secondary market.
The primary market is where the first common securities offer is offered to investors, while the secondary market is a market that is facilitated by the stock exchange to buy and sell shares that have been obtained while on the primary market.
Okay, the next material is the difference between capital market and money market. Capital market and money market are types of financial markets. Money markets are used for short-term lending and borrowing. Usually the assets are held on 1 year or less, whereas capital markets are used for long-term securities. They have a direct or indirect impact on the capital. Capital market include the equities market and the debt market. The differences are: Number 1. The short-term securities are traded in money market, whereas long-term securities are traded in capital markets. Number 2. The capital markets are well organized, whereas money markets are not that organized. Number 3. Liquidity is high in the money market, but in the capital market, liquidity is comparatively low. Number 4. Instruments in money markets are low risk, whereas capital markets are the comparatively high risk. Number 5. A central bank, commercial bank, and non-financial institutions are majorly working money markets, whereas stock exchanges, commercial bank, and non-banking institutions are working capital markets. Okay, next, the role of capital markets. The role of capital markets are increase capital business entities, increase equalization, increase production capacity, creating jobs, increase state income, and economic indicators of the country.
Capital market products. Firstly, shares. A site of ownership of a person or legal entity for a company. This site means that the owner is entitled to the profit generated by the company, has the right to use his opinion at the general meeting of shareholders, and it is entitled to the asset of the company. Secondly, bonds. Proof of debt or securities which contains a statement that the owner of the latter has provided a loan to the borrower by contract, and it has been stated that the lender has the right to be repaid at a certain time and amount. Thirdly, mutual funds. Mutual funds are a medium for raising funds from the investor community, whose funds are then invested in securities portfolios by investment managers who have obtained permission from the regulator. Fourthly, warrants. It is a security issued by a company that claims that the owner of the certificate to buy shares in the company according to applicable requirements. These terms usually relate to the price, amount, and the duration of the warrants. Fifthly, right issue. It is the investor's right to buy new shares issued by the issuer. In general, the price of shares purchased by showing ownership of a right issue will be cheaper than shares purchased without ownership of this right issue.
Hello, my name is Dewi Sri Wahyuni. I will explain the material part, capital market players. We acknowledge the predators involved in the trading activities of the capital market are as follows. First, emittent. Those side offer the effect to the trade. Secondly, effect companies. Companies that get business permits from stock market regulation. Third, investor may be individual, institution, domestic enterprise, or foreigners. Next, we will discuss about transaction mechanism. A series of the procedure must be faced in a capital market transaction mechanism. But each party involved in the effect of trading activities in the stock market should be connected to the effect company or broker. Effect company have a system connected to a system in a bed that commonly called online trading. With this as of the system and the services, the parties involved will have to pay emission cost to the brokerage firm. You look at the tile of illustration below. Before making transaction in the stock market, prospective investors are obliged to open an account in effect company. By opening account, official investors have already listed as a customer, and the identity date of investor already record of the inner official account of the effect company. To this end, investors are expected to agree on the terms of the right and oblige of both sides.